Hello everyone, my name is Vikas Shukla and today I am presenting to you my strategy of investing in stock, and I call it buying at the dips strategy. This strategy has been very useful for me. I've been very successful about it, and if you subscribe to my channel, I will be sharing at some point of time showing you my data of how I invested and profited from this strategy. So the strategy is very simple, but you need to be very disciplined at it. You should not be using your emotions, but just follow through the principles, and then you can tweak it at your as per your temperament. But the basic theme of this strategy is very simple. What I do is that let's say I have $90,000 in a stock, and I need to keep a reasonably good amount of the money with me in hand ready for investment. What I mean by this is that I will be investing only a very small part of it to start with, but I should be ready to invest more if required. And this can be done, for example, using one way. Maybe you do not have $90,000 right in your bank account sitting at the all the time. What you could do is, for example, if you have a home equity, you could open a home equity line of credit. So that amount against that home equity is available to you, but you are not using all of that at one time. In fact, I will start with only 1/10 of that amount. If I can potentially invest 90,000, I will start with only $9,000, and I will go through more details about it, about their pros and cons of it. I'm expecting that the home equity line of credit will get you that potential credit at a very low interest, and you will be paying the interest only when you draw from that account. So if you don't buy anything more than $9,000, probably you won't make much money, but you will also not lose much money. So let's start with $9,000, and what I do is that $9,000 is divided into three different parts: 3,000, 3,000, 3,000. You choose three stocks, and I'm not going to go into the details of which stock you buy. Now, if you do not have $90,000, for example, you have only $45,000, you will take 1/10 of it, which is $4,500, and divide it into three different stocks. And that step is very important. You may be tempted to invest all your money in one stock, and I will highly advise against it, and I will come to that shortly. What I do is I take that $3,000 and invest it into stock number one. And when I do this this step, typically when the market index is at least 10% down from its peak, or that particular stock is at least 10% down from its peak. If it's lower, even better, but at least 10%. For example, right now S&P 500 index is around 3,200, which is not exactly 10% down from its peak of 3,400. So I may wait a little bit to settle it down, or if I choose a stock, that stock should be at least 10% down from its peak. For example, the Intel stock right now, which is sitting at around 20% down from its peak of like $65 or whatever. It's right now at 47 or 47. So that's the stock I can start buying. But again, my amount is limited to 1/3 of the total amount that I plan to invest. And then I do the same thing for the second one and the third stock. I divide it into three parts, and then I wait. If it rises, it's good. I don't make a huge amount of money, but I do make some money on its rise of this $3,000 to whatever it rises to. But at some point of time, it's always very possible that this stock can go down. If it goes down a little bit, 2, 3, 4%, I don't do anything. I just wait and watch. But if it goes down by 10%, for example, if the stock is like $50 and it goes down to $45, I buy 2x the amount of this share. So if I initially invested $3,000, I will buy that stock at 10% down for $6,000. And then again I wait. It's possible to start rising up. In that case, I make more money. My arithmetic average of this is not 3,000. The stock price is not the 10% down somewhere closer to the down price. So my averaging down is at a much lower price. That's the key strategy of this, which is that this weighted average, because I bought it in higher number of shares at a lower price, my weighted average is at a lower price. And then again it can go down. So if it goes down by a further 10%, I buy 3x of that amount, and that will be of $9,000 of share. And then again if it goes down, it will be I will buy 4x of that amount, will be $12,000. So if you look at that, I already started by 10% down, and again 10% down, it's 20% down here, 30% down here, 40% down here, and here I stop. I don't go any further, because historically the stock is, if you look at the index, those are typically down like 50% historically. So I don't, on an average, I mean, if you don't talk about an individual stock, on an average from the peak it won't go down much below from there. It will find a bottom and will go up. And that same thing for the second stock and third stock. Now, why I would divide it into three stocks is this. Typically when it starts going down, it's always possible that it will go down all the way down to like 50, 60, 70% of down, and maybe even bankrupt. In that case, you are going to lose your whole amount in that one stock. In fact, if I could, I would diversify it into five stocks or so if I have a higher amount, but then it will be too much of diversification. If you could do, I will advise for it. But at least three of them. So if this one goes bankrupt, you lose only your money in one stock. Typically, in the typical scenario, what happens is at some point of time it goes down and starts rebounding from somewhere at the bottom. And when it starts going down, because your weighted average is at a much lower point, you start making more money. There are more things about it, and that you should be aware of that your whole amount that you plan to do will not be invested typically. Typically, you will be investing only a very small part of your investable amount, and that's where you need a discipline, and that kind of thing works very good if you have something like a home equity line of credit. If you have that money sitting like a cash in your account, that strategy is probably not very good. You should have some money which is lying, and not you're not paying much. You draw it only when you need it. So this is the strategy I have worked, and I have always seen it in most of the scenario it worked. Although in couple of time it does give you very negative. Sometimes it goes much below this, in which case you get run out of money, and then you need to wait and then for it to come up. And in very rare situations, it can also, company may go bankrupt, and you have to be prepared for that. So I hope this is helpful for you. If you think along with this strategy can be combined with the put sell strategy, which is what I do, and I get even more benefit. If you subscribe to this channel, I will come up with my own portfolio and show you how you could be benefited from it. Thanks for taking a look.